Hey everyone, welcome. Happy Monday. One might be a short week for everyone. I know we have Veterans Day tomorrow, so thank you everyone for joining today. Um, we're gonna take a few moments to give everyone a few minutes to roll in. We already have 50 some of you here, which is awesome. Thank you for joining. We'll give everybody a couple more minutes as well to join. In the meantime, we'd love to make these as interactive as possible. So we encourage you to ask us questions as we go through this webinar. We want to make sure you get value out of here, not that just Tyler and I are here chatting. So please ask questions throughout. We'll do our best to address them. It's a little bit of icebreaker while we wait for a few more people to roll in. We already have 66 here today. If you let us know where you're joining us from, what your name is, where you're joining us from, and if you currently have a short-term rental or not, using the chat function here in Zoom, that we would love to do that. For some context, I'm Emir. I'm the CEO of Rabbu. We're based in Charlotte, North Carolina, and I have 15 units myself that I own, including a hotel in Asheville. And speaking of Asheville, Tyler, welcome.
Hey, Mir. How are you, man?
Doing well, sir. Glad to have you here. You want to just tell people quickly about yourself, where you joining us from, and what you do? If people don't know, which I'd be shocked if they don't know who you are. With that hair,
Right.
everybody has seen it, but yeah, let us know where you join us from.
I've been told that I got to make the silhouette of my hair like some sort of a logo or something like that, and that's in the works. It'll be later.
It would do wonders. You should do it.
Uh, my name is Tyler Coon. I'm the CEO and founder of Savvy STR Agents. We are a short-term rental specific real estate team throughout the US. We're in over 25 markets. All of my agents only sell short-term rentals. Some of them should be here watching. So if you have questions about buying short-term rentals, definitely a good place to ask those.
Absolutely. And thank you all. First of all, Tyler, thank you for joining, but everybody else who's already leaving comments in the chat section, thank you for doing that. Again, we want to make these as interactive as possible. And it looks like we have a lot of newbies here. So we have Lisa is from Michigan, Abe is from the Bay Area, we have Rodrigo from Washington State. No STRs has some midterm rentals, which is great. Definitely a different type of strategy. Annie, she's trying to buy her first in the next month. So welcome, Annie. Thank you for joining us. Jason from Springfield, Missouri. Awesome. He doesn't have any SDR. So it looks like a lot of newcomers here, um, Tyler. So that's exciting. This is the
So
best group to
awesome.
talk to. Yeah,
I
this is
know.
great.
I'll tell you guys, I love first-time investors because they're the most open to new ideas. And the short-term rental industry is always evolving and changing. And so, for me, and I suffer from this as well, like getting jaded, right, in the short-term rental industry and feeling like I know it all. So I always love to work with first-time investors, specifically because they're open to new ideas. I heard this last week at a conference I was at. You learn best by teaching. So when I work with first-time investors, I get new ideas. So I'm really, really glad that you guys are here. And we hope that you get a lot from this.
Yeah, absolutely. And again, thank you all for already commenting. Let's see, I think I saw Cassie. Yeah, Cassie is closing on her first STR in Sun River, Oregon in a week and a half. I'm sure that's exciting and nerve-wracking at the same time, but congrats, Cassie. And thank you for joining us. Brandon as well from Breckenridge. Lillian from Seattle. Wow, we got basically the whole country covered. Um, so again, thank you all for joining. And please use the chat functionality to ask myself and Tyler questions as we go through here. But again, excited to have you guys here, especially so many new investors. I know we're a little bit time frame. It's November 10th, which means we're close to the end of the year. There's a lot of things we want to talk about, especially around bonus depreciation. But before jumping into that, some of you may have seen some pretty significant short-term rental news this morning. We figured we would quickly just discuss, especially for a lot of newcomers. Um, some of you may have seen recently that a company named Sonder has broken off, or Marriott, which we all are familiar with, the large hotel brand, recently broke off its relationship with a short-term rental operator called Sonder. And that's actually forced Sonder to go out of business. And being online today, I've seen a lot of questions, why did this happen? How does this impact me? Especially as someone who's looking to buy their first short-term rental. I think we should probably address that first, don't you think, Tom? Just to make sure people understand what's different about what they're thinking about doing versus what Sonder does, right? Maybe we start there.
Yeah. Yeah,
Yeah.
yeah.
Yeah. So maybe I'll take the first part of it and I'll let you chime in. So for you guys that don't know, Sonder is a national operator, and the way they operate it is actually very different than what you guys are looking to do. What Sonder did is they would go to an entire brand new apartment building, and before that apartment building had any long-term tenants in it, they would come in and say, "Hey, landlord or developer, I'll rent out your entire building from you and I'll turn it into short-term rentals." But in the meantime, they signed leases, liabilities on those buildings for multiple years, went
Lots,
and furnished them.
lots of
Lots of
leases.
lots of leases. I mean, thousands of leases. And they were able to scale that throughout the world. They had properties obviously throughout the US, but then, in Europe as well. And I think maybe even made it out to Asia and South America. But they were the largest kind of multi-family operator of short-term rentals. But their business model was this, what's called rental arbitrage, where they would rent a property themselves and then they would arbitrage it with short-term rentals. And they raised a significant sum of venture capital, I think over $600 million, but they just couldn't scale it. And they ran out of funds because they really literally bought liabilities and leases versus actually owning the asset itself. So that's a really big
Mm,
differentiator between what I think many of you guys are looking to do, which you're actually owning the real estate and you're owning the appreciation of that asset, versus what Sonder did is they were leasing somebody else's real estate and hoping to arbitrage it.
yeah,
So,
and I think it really speaks to the dangers of arbitrage. I know that that model used to work. It is becoming more and more difficult. I think as this industry matures, we're seeing, like, if you've watched kind of what we've done in Asheville, I have to warn people when they come to buy in Asheville anymore that you really have to be ready to put down some big dollars for design and amenities here because of some of the things we've done here. And this will not only happen in Asheville, it is happening here because of me being here, certainly. But this will scale across the country. These better design, better amenities, and I like to call it an experiential stay. People aren't just looking for 3 bed, 2 bath with a bunch of IKEA furniture in it anymore. The novelty of walking into somebody else's home has worn off. And people do expect a nice experience when they stay in short-term rentals. And the difficult part about doing that on something that you're arbitraging and that you don't own is putting all that money into improvements. That's a lot more risk up front. And if it doesn't work out, now you're screwed. Now you have to pull all of that back out versus where if it's a house, you have an exit opportunity in terms of what you've put into the house actually has built equity for you. So I think that's probably one of the biggest things that impacted them is the way that the industry is maturing and what guests are expecting.
Yeah, exactly right. And I saw Mark Younger, who's actually one of our partners as well, jump in and say you guys should chat. Mark does a great job actually designing STRs in the Orlando area, and he does exactly what you just mentioned, Tyler, which is he themes them out uh, just so that he helps guests create that experience. And that's what you have to do. You can never do that when you're arbitraging somebody else's apartment. So I just wanted to quickly touch on that topic because it's pertinent news today in what's happening in the short-term rental world. But to us, myself, Tyler, the Savvy team, Mark, who commented a second ago in the comment section. Again, encourage everybody to leave comments there in the chat. None of us would ever consider anybody who's arbitraging to be a true short-term rental investor. They're just somebody who's trying to maybe make some money with the arbitrage play, but really there's not much money to be made if you're going that way. You're taking on too much liability, too much risk.
Yeah.
Just wanted to get that off the table just to make sure we cover that pertinent topic. But let's jump into this, doing what this group cares about, discussing what this group cares about, which is buying your first short-term rental before the end of the year and why you should do it. The biggest thing, maybe we should probably start off with, we're talking about bonus depreciation a little bit. Tali, you want to tell us what that is and help educate our listeners
Yeah.
what exactly bonus depreciation is and why it matters to them, especially if they're looking to buy this year?
Yeah, absolutely. So with bonus depreciation, this is how the wealthy get wealthier, right? This is how when Grant Cardone goes and buys a $50 million jet, he can finance that jet, but write off the entire purchase in the first year, right? It's just like you've probably heard more often, you can buy an SUV over 6,000 pounds, you can finance it, but you can actually write off the entire amount in that first year, you can depreciate that asset. So with the short-term rental loophole, you can actually do the same thing with a short-term rental. So it's different than multifamily, it's different than long-term rentals. You can only do this in short-term rentals, and you do this via a mechanism called a cost segregation study. So you would work with a an engineering firm that can do these cost segregation studies. They're very readily available nowadays. You can do them virtually. There are even do-it-yourself options. They even have audit protection risks. We could talk about some of that throughout the rest of the webinar. But ultimately, a cost segregation study, it's a specialized tax analysis that breaks down a property into its individual components. So normally, you can depreciate in something like a short-term rental, long-term rental over the long haul. You can depreciate a little bit every year over a certain number of years. I think it's something like 27 and a half years, right? The cost segregation study allows you to accelerate that depreciation, right? And so what that does is the cost segregation, it segregates down a property into its individual components. So things like flooring, appliances, lighting, landscaping, decks, and other things. Each part can be depreciated faster instead of slowly over the 27 and a half years. And so what they segregate out is the amount basically that you can attribute to flooring in your house, the amount you can attribute to lighting, the amount you can attribute to appliances. And then there are tranches, let's say over 5 years you can depreciate. I don't want to get so granular that I make a mistake and say
Right.
the wrong thing.
It varies by
Yeah, it
also
varies.
by
And
the
so some of
property.
them are 5 years, some are 10 years, some are 15 years. So that's what the cost segregation engineering report is for. And then you submit that to your CPA and you save a crap load of money. It's goes from very complicated to very simple. When you use this mechanism, which anyone that has a high W-2 tax burden can utilize, it becomes very, very lucrative very quick. And here is the key, I think, for folks right now. Most of my clients these days are putting down 10% on a second home loan. And Amir's got some really, really good referrals for lenders if you still need one. So most of my clients are putting down 10% on a second home loan. Let's say that's $1 million purchase. They put down $100,000 on that next year on that purchase. And this is super 10,000 foot view. This will not apply in every scenario. We can talk about different scenarios where this applies less or more, different parts of the country, whether it's the beach or the mountains. But on kind of an easy to understand level, they'll save $100,000 in taxes next year, right? So they spent 100,000 on down payment. They will save $100,000 in taxes next year. Okay.
Yeah.
Again, that will change. It will vary. It has to be done via this study. The land value versus the actual property's value matters, but that's kind of a 50,000 foot super high level view, kind of back of the napkin math.
Yeah, and it does vary. It's very important to note. It varies on your personal tax situation and varies on your personal income and varies on the property and what all you can depreciate. But there's some significant savings. And this is something maybe worth mentioning too, that bonus depreciation has been around for a while. It was actually pulled back a little bit, maybe 2 or 3 years ago, and then it was brought back. 100% bonus depreciation was brought back with the about getting political here with the one big beautiful bill that was signed on July 4th, and that's really kind of created a new push towards short-term rentals and making sure that if you're an investor, you take advantage of this asset class. And I love all these questions that are coming in, so really appreciate that. Before doing that, let's talk on one more topic because I do want to answer a lot of these questions because they're great and it's exactly what we're hoping to accomplish here today. You want to talk about material participation real quick, Tyler, just so our guests can understand what they need to do in order to qualify uh, for this bonus depreciation?
The first thing you need to do is talk to your own CPA, or your own cost seg company. I want to put a big asterisk here. I am not a CPA. I am not a licensed financial advisor. I am not affiliated with a cost segregation company. So every piece of information that I'm giving you today is super educational. I want you to take this to the professionals and then go apply it with them to your personal scenario. With that being said, material participation, from what I understand and what my CPA tells me, there's three different tests. The first test is that you participate materially everything. You do all of the work for that short-term rental in the year that it was put into service. The second test is that you do more than 100 hours of work than anyone else. And the third test is that you put in over 500 hours. Okay, so those are the three tests. You have to hit one of those. So to answer Cassie's question, yes, I'm sorry, this is Matthew's question. Yes, it absolutely is feasible to pass the material participation test with so little time left this year. You really want to talk to a CPA or a cost segregation company about what that looks like, and ultimately, how you can pass that in a few different ways. So there are a lot of different tactics out there to do it, and different CPAs will tell you different things, right? It's all up to have they been audited before based on the advice that they're putting out there. But ultimately, right now, the IRS is very friendly. A lot of IRS agents have been fired, so that's something I think to take into account as well.
Yeah, I mean, there's thousands of buyers right now using Rabbu who understand it probably on their personal situation a little bit more. And they're looking for properties right now. They want to find a property in the next week and a half, 2 weeks, so they can close before the end of the year and can host the first few guests so that they can then go ahead and take advantage of bonus depreciation for this year, meaning that come 2026, when they file their 2025 taxes, because they closed on the property in this year in 2025 and they put it to work or had the first two guests stay in the 2025 calendar year, they're able to get that bonus depreciation and take advantage of those tax savings in next year's tax return. So that's exactly right. I had an interesting question to hear from Justin, and I don't know if you know this answer, Tyler, and I'm not 100% sure either. But do you know if does this apply to midterm rentals as well?
It does not. No, those stays have to be under an average of 7 days apiece. So it is the short-term
Okay.
rental loophole. If you go over an average of 7 days, it becomes passive income, which is taxed differently. So the reason that this works is because when it's under an average of 7 days per rental, it now becomes active income, which is how you can write it off against your other active income. So that's how it's put into the same bucket as your W-2 work. And that's why the material participation test matters, is to say, you basically have two jobs. And so they're counting the short-term rental as your active income versus your passive income, which then would be taxed differently and you would not be able to bonus depreciate. Now,
Yeah.
this also, there's a little bit of a loophole here, like a second loophole. If you already have real estate professional status for some reason, you do not have to have material participation at all. You already have it via your status as a real estate professional. And so, what we'll see some people do is we will see some folks where, let's say you have a married couple and one is working at Google, they're making 250K, 350K a year. The other is active in their real estate investments all year long. To get real estate professional status, you have to, the third test, have over 500 hours working in your properties every year. That gives you real estate professional status, which now moves all of your passive real estate activity to active. Again, this is all stuff you want to run past the CPA. I don't want to claim that I'm licensed CPA or anything like that, but after selling over 300 short-term rentals, I've done this enough times. After buying almost $10 million in short-term rentals this year myself, I've done this enough times to feel confident enough to guide you guys down the path, but ultimately everybody's scenario is different. So we want you guys to talk to your own licensed professionals as well. But happy
Yep.
to at least start you down this path.
Correct. Exactly right. Unfortunately, the best thing Tyler and I can do today is kind of give you a high level overview of what's out there and what's feasible. We can also talk you through the steps that you can take, throughout the rest of November to find the property and get that property purchased. But you will have to talk to your own kind of tax professional to make sure what strategy works best for you and how it perfectly applies for you. Unfortunately, we can't give you that answer. We're not licensed to, but rest assured, best parameter I would set here is that there's thousands of other buyers in your shoes trying to do the same exact thing with kind of trying to get a property closed before the end of the year and
Yeah, and
the
if
first
you're
guest hosted. Good.
and if your CPA or your accountant or whoever you're dealing with really can't answer these questions, because all of them can't. It's only specific types of CPAs that are truly going to understand how to do this and the different mechanisms that you can use. Shoot me an email. I'm happy to connect you with a decent tax professional that can help. I'm just going to throw my email in the chat there. So if you guys want to shoot me a quick email anytime, asking either for a cost segregation recommendation, we work with CSA, or a tax
Yeah,
professional. I
great.
have two or three that can help answer some of those questions this week. If your goal, and I know one of the big purposes of this webinar was to talk about how do you still make this happen this year? If your goal is to close on something before the end of the year, you must put it under contract in the next 7 to 10 days. There's not much time left. Unless you're buying with cash, that gives you a little bit more timeline. Amir and I were talking about this the other day. But if you're financing a property, you have days left, not weeks.
Yeah, let's double down on that point, Tyler. Why do you say they have days, not weeks? Why
Yeah.
exactly is that? What are the hurdles they have to overcome before the end of the year to in
It's the
order to take
timelines,
advantage of
right?
this? Yep.
So if you're doing a second home loan, if you're doing a DSCR loan, you're not closing faster than 30 days, especially right now, especially with any lender that's working on investment loans. This is their busiest time of year, right? This is cost seg season. Those of us in the industry, I've been calling it that for 3 or 4 years. And I now think that the term is coined. Everybody's super, super busy and slammed, but we love helping people this time of year because this is how those ultra, ultra, ultra rich get wealthy. And that's what the big beautiful bill did. And I'm not getting into politics here or landing on any side of things here, simply talking about this one mechanism that was handed back to us. But this is how those of us that do not have tens of millions or hundreds of millions or billions of dollars, we get to that level. This is the mechanism in which we do it. And they have given this tax break to everybody in the country. Everybody can take advantage of this. And this is how people really accelerate their wealth. This year, I wrote in September a $240,000 check to the IRS, and it was terrible. And it's why all this year I've focused on buying real estate. And we ended up buying almost $10 million in short term rentals this year. So a lot of people have questions about, is the short term rental industry still worth investing in? That's a whole other topic. And I think Amir and I are happy to speak on that because we're both really confident in this industry. But ultimately, for me as an investor, as a real estate agent, and the owner of this team, I put my money where my mouth is. So I've bought more real estate than I know any of my investors have.
That's exactly right. Same. I'm in the same boat. Let's get back to the timeline real quick. So you mentioned lenders need about 30 days to help you finance the property. Yeah, and thank you, Abe, for the nice comment I saw here earlier. If you are looking for a lender that specializes in short-term rentals, highly recommend to use our Airbnb loans page. So if you go to Rabbu.com, you'll see a loans page, a loans button across the top. We have some of the best lenders across the country who can help you finance. 30 days is probably the average. Some can be a little bit more aggressive depending on the situation, but it's definitely, important to get something, get a property on a contract and get the process started sooner than later. So if you have 30 days, then Tyler, from, the day you find a property, put it on a contract for to actually to close on the financing, what else needs to happen before the end of the year for you to be able to take advantage of this?
Yeah, and that's a minimum, right? I mean, if your
You're right.
closing gets
Sure.
delayed 5 or 10 days, you don't want to lose the tax benefits over something like that. That happened to me last year on one of our purchases, which is one reason I did write such a big check. We didn't close till December 31st, and there's no way to get 2 stays in before December 31st. We still went through with the property. It was still worth it. We're selling that property now for 400,000 more than we bought it for, so it ended up being worth it. But yeah, I think ultimately, if you look at where we are right now, November 10th, if you go 30 days just from today, you're already in mid-December. Let's say you don't find a property. If you start looking today, you don't find a property for the next 7 days. Now you're starting to get to that mid to late December time. You need to get 2 stays in. This is what the tax professionals tell us, right? This is not codified. There is no actual definition of this, but what most tax professionals agree upon is that you need to get 2 stays in before the end of the year. We have seen a lot of people submit their taxes with one and be just fine. But I think ultimately most CPAs will at least recommend getting into if you can. And so to do all of those things, the great thing is that at the end of the year, you can buy almost anywhere in the country and guarantee that if you put air mattresses in the house, you should be able to get a stay for a couple bucks for Christmas and New Year's, right?
Yeah.
So that's one nice thing about this time of year. We're not kind of in a dead time. Like this is the number one holiday for short-term rentals. So you should almost always be able to get that. What a lot of people are doing right now, and this moves into like what sort of property do you have to buy? But a lot of people, if they're buying something that's not currently a short-term rental, they will furnish it as bare bones as they can, get some photos up and get that thing rented out for as cheap as they can, at least just for a couple days so that they can take advantage of those tax benefits. But I think Amir and I have more to speak on how you can actually make this happen this year and how you need to
Yeah.
shift your focus to do that.
Yeah, that was a question I was trying to find in the chat, and you made a really important point there, Tyler. What else needs to happen besides closing on the property? You need to host two stays. Does the length of that stay matter? Or can it be two overnight stays? But to qualify, you have to host two stays, right? Does it matter how long the guests stay? As long as you get two, is there a number of
As long
days
as it's
involved?
under 7 days is what everybody tells me. So if they have two 1 day stays, right? So this is
Yep.
why, closing and then having a couple days to get your listing up, get the photos uploaded, and have that buffer as well. The closer you get to December 1st, the less likely everything becomes.
Yep. Exactly right. Um, the cost segregation study, because I've seen some questions pop in around that. Does that need to happen this year, or can it happen next year?
Yeah, absolutely. It can happen next year, and that's typically what
Yeah.
we recommend.
Yeah.
Don't try to get all that done this year. You'll go too fast, and especially we're going into the holidays, so you don't want to rush the engineering firms on that. I filed my taxes finally in September, and we ended up doing both of our cost segregation studies for last year in September,
Yeah.
right before we filed
Exactly
taxes.
right. Yeah, again, best time to do it is before you file your taxes. Just make sure your CPA and your accountant has that when you file your taxes by April or whatever your situation may be. And it has to be done by then. Okay, awesome. So hopefully that makes sense for you guys. Now, can somebody find a property today, close on it, so today's what, November 10th, close on it December 10th. I didn't even look. Let's assume that's a Monday. And can they get a property ready in time if it hasn't been a short-term rental before to host their first guests?
Maybe right now you could because you will have a little time. 30 days from today is actually December 10th. That was really good math. And so you do still have a little bit of time, right? Like if you could get and fly out to your place and get it furnished in 10 days, that would put you online on December 20th and get 2 days before December 30th. I think that that would probably be fine, but that implies that you find something today and put it under contract, which I see a lot of you guys here do have something under contract. So congratulations on that. But if you get a delay in lending, which is possible at these times of year, you're going to go through Thanksgiving week, which is going to delay all the banks. It's going to delay all the agents. It's going to delay all the inspectors, all the appraisers, all the things that you need to get done to close in 30 days. It's going to delay all those things. So I would just imagine at this time of year that maybe you buffer in 35 days to close. It's all going to depend on the agent that you work with, the lender you work with, and how fast they can move. If they're not incredibly used to moving super fast this time of year, I don't know that I would work with them. For instance, I take all my trips, all my vacation. I will not leave this desk or leave this office from now until the end of December. I'm locked in. I'm here. Like I know that this is go time for people because everything needs to be. When I get an email about something, a negotiation, an inspection, something like that, it needs to be right back because we don't have days to waste anymore. Because it's the difference between saving hundreds of thousands or not. And I want to be on the good side of that equation.
Yeah, exactly right. Got a couple more questions pop in around timing, really, and questions around, hey, what happens? Can that, if I captured a couple questions related to this, and we might want to host another one maybe later this week or next week, Tyler,
Yeah.
with one of our cost seg partners who can actually answer some of these more specific kind of questions. But are you aware of what happens if you sell your property in two or 3 years, what a recapture would look like?
Yeah, the recapture on something like that's going to be pretty significant, right? And so what a lot of people do in this situation is they start this property is going to be a 1031 property. So I would not look at these properties as being able to cash out via a sale your equity. What a lot of people do with these types of properties, and you have to figure this out for your financial, um, where you are and what season you're in your own financial capacity, you and your family. For me, when I buy a short-term rental and then I heavily improve it, we're adding all the amenities, adding great design, so it cash flows really, really well. I look at that as I'm never going to cash in on that equity via a sale again. I'm looking at a death tax, right? This is 1031 all the way until I die. And so the reason that I would do that and why would I do that is because there's a few different ways you can access that equity. You could do a cash out refinance and you can access that equity tax free, which is great. So I did that on a property I bought in let's see, February of 2023. So 2.5 years ago, basically, I bought a property for 850,000 in Asheville, and I heavily improved it this year, redesigned it, put about 300 grand into it, and that property reappraised for 2.19 million. So not only was I then able to do another cost seg study on it because of the massive improvements, this is my second cost seg on this one property, but then I also was able to capture every single dollar I've ever put into it. So now I look at that property as like I don't need to sell it to capture the value. I'm cash flowing on it. I've already captured the value out of it via debt. My cash flow is high enough that that debt is more than well serviced. Even if my cash flow went in half the debt, there would be service. So I felt really comfortable with that whole scenario. But you have to kind of do that math for yourself and what works out for you and your family. Can you risk that amount of equity floating out there to get all of that done without putting yourself in too deep of a hole ever, and then not so that you don't have to sell it. So if you have a property that's not working out that you have cost seg, the best thing to do is sell it and then 1031 into another property.
Yeah, just real quick, in like 15 seconds or less, can you explain to our guests what the 1031 is, just so they
Yeah,
know?
1031 exchange is a tax deferral, right? And so it's a legal mechanism where you sell a property and instead of getting taxed on the capital gains, all of the proceeds of that sale go to a 1031 intermediary company, which we're happy to recommend one. They hold on to those proceeds, and then within 45 days, you identify another property that you're going to buy with those proceeds. You can
Yep.
identify two properties or three properties. And so this is why someone would do a 1031 is because let's say I sold that property for 2.19 million. I would then have to buy more properties to have more than double the cash flow that I would be getting from the one that I have right now, right? To make it worth it for me.
Yep, exactly right. And remember, you've already captured the bonus depreciation, so if you already, received most of your down payment, if not all of your down payment money back, you're just not taking any of your proceeds and reinvesting into more real estate. So it's just hopefully creating more cash flowing assets for you and creating that financial freedom that I know we're all looking for. Angela, an interesting question. She's asking, does material participation only count after the property is listed, or does time spent acquiring the property and getting it ready count as well?
It does not, unfortunately, it does not. Um, Time spent getting the property ready does. So there's a separation there. Going under once you own the property, that's when your participation starts, unfortunately.
Exactly. So
Yeah.
hopefully that made sense. Angela, you looking for the property doesn't count, but once you have it, once it's yours, once you sign the paperwork, you then any second you spend getting the property ready, whether that's, furnishing it, building the furniture yourself, finding the cleaners, finding the maintenance team members, building the Airbnb listing,
Yeah,
all
setting up all
that
the
does count.
software, all that can
Yep.
take a long time, right?
It adds up quickly. It
Yeah.
does add up very quickly. So that definitely counts. Um, if you were in one of our buyer's shoes right now, Tyler, what would you be doing today to find that property in the next 7 to 10 days? And what type of property would you be looking for?
Yeah, the first thing I would do in any area where you have a compressed amount of time, you have to figure out some mechanism of leverage, right? And so this is one of the reasons that I bought Savvy was for buyers to be able to leverage us. And so you can have one phone call with my team internally, and this is not like a big sales pitch. Like we do this as a value to our clients, and if it is, then great, and if it's not, then it's free. But we do a market match call with you. We figure out your budget, what are your desires, what do you like, what do you not like, what areas do you like, and then we pair you. We have a list of 65 agents and markets all across the country. We pair you with markets that fit your ideal scenario, whether that's really based on your budget or it's based on you saying, no, I really want to be somewhere at the beach. The main thing that I want people to know is that there's no number one Airbnb market in the country. Because if somebody said, this is the number one Airbnb in the market in the country, tomorrow it wouldn't be because everybody would race there. They would buy everything on the market, they would saturate it, and it wouldn't be the number one anymore. You can find a deal anywhere in the country, right? It's just when does it come up? How much is it for? Does the deal work for your personal scenario? One thing I will say nowadays, though, is the retail buyer, all of you, all of us, we got to watch out. We have to band together and we do have to use some sort of leverage because the institutional money is flowing in. And people were talking about this 2 or 3 years ago that Wall Street would catch on and family offices would catch on and the funds would catch on. And I am here to tell you that they have caught on. They are calling me every day saying, I need to place $20 million before the end of the year. I need to place $6 million or $7 million before the end of the year. I get a text message on Friday night at 5 o'clock, which I didn't, I said any other time this week would have been really helpful, but everybody's gone now. He said, I need to buy five more before the end of the year. I'm like, are you crazy, dude? Like, okay, let's get on it. We'll work on it. But the institutional money is here. And what does that mean is increased competition for you. So how do you beat out those institutional buyers? You have to have leverage out there. And so what that means is using Savvy or another company out there like it, which I don't know of any, use Savvy to go out there and work with 5 or 10 different agents, get those best VIP deals sent to you first before the funds get access to them. Here's one thing that I will say about a retail buyer versus a fund where you have a slight advantage is that they are not always willing to commit to a real estate agent in on a buyer's agency agreement, where most retail buyers are. They've interviewed the agent, they're willing to hire them, they do hire them, and for me, my retail clients always get my best deals first, because I know you're committed, I know you're there, you've gone through the whole process with me. So that's the first thing that I would do after you have good leverage on your side. You got to be looking for super turnkey properties this time of year, I think. Gone are the days, at least a few months ago, maybe, where you could have bought something and turned it into the next best short-term rental. If that opportunity does still exist, it's where at this point you are flying to wherever you buy your short-term rental and designing it yourself and getting it launched in 10 days. And that is very, very difficult to do, especially you think around the holidays. You're trying to get TVs on Black Friday, you're trying to get mattresses on Christmas. Very, very difficult to try to launch a property this time of year yourself. It's impossible to hire a designer to have them do it for you at this point. Everybody's booked out till the end of the year. So the best place for you to keep your eyes if you really want to leverage and be really efficient is to just look at turnkey properties right now.
Yeah. And turnkey meaning that this is an existing Airbnb that the seller is selling, and it's literally you sign the paperwork and you can host the next guest, right? When you say turnkey, that's what you mean. Maybe you want to make
Yep.
some slight improvements, but you're not, you're not redesigning the whole house.
Yeah, exactly. Something, and likely it's something that's already got those two rentals on the books, right? It's
Yeah.
something that is very, very difficult to screw up before the end of the year.
Yeah, meaning
And
when you say meaning two rentals on the books, meaning it's something a lot of times, not often, not always. When you buy a turnkey property, you can also get the reservations, the Airbnb or the Vrbo account with it, so that you don't have to worry about finding a guest in time. You can just take advantage of the existing. reservations that are already happening over Christmas and New Year's.
That's
Right.
exactly right. And Eric, I
Yeah.
think, had a good question here, which is if you closed on the property, if you put in the 100 hours, you did the cost seg, which you don't have to do this year, you can do that next year, but you don't have the short-term rental permit from the town yet, are you not able to deduct the bonus depreciation? You have to rent that property to two guests. So there's a few different things you can do, I think, here. If you're not going to like risk it and put it on Airbnb, I want to put a big asterisk here. I'm not a lawyer. You should not take legal advice from me. You should talk to a lawyer. What I would say is like if you're in a place that doesn't have a short-term rental, that requires you to have a short-term rental permit, the main way that those cities or counties or whatever find out about your short-term rental to fine you, right? If you have something unlicensed, and this is only in the case where if like you feel really confident it's coming beginning of January, this wouldn't be like a huge risk or anything like that, but would maybe be to rent it out if you have some friends and family that want to go to that area, right? Not putting it out on the big portals. I would like I would I think it would be very difficult for your city or town to find out. Again, not trying to recommend you do anything, under board, but I think if you were to try to get those 2 stays, that's the direction that I'd be looking, anyways.
Yeah. Exactly right. And those two states, and there's a question here from Annie. Are you saying she asked, are you saying that if I close this year and don't host two stays this year, then I miss the window for cost seg for this property? And the answer is yes for this year, correct?
For 2025, right? So it would go into service in 2026. The good thing is that we're not cascading down in the percentages that cost seg works anymore, which is what the big beautiful bill did. It put all the bonus depreciation back at 100%, where next year it should have actually been at 20%. So instead of in that $1 million example saving 100 grand, you would have only saved 20 grand, making it almost not worth it, all the hassle and everything buying towards the end of the year. Yes, it would bump that tax savings to your 2026 bill, which obviously you pay in 2027. So this is where right now the rubber meets the road to accelerating your wealth building. This means another 100 grand in your pocket or whatever you end up, saving in taxes next year so that you can make another investment early next year. And then potentially, if you want to write off even more income, you make a second investment next year. And you would be able to do all of that because of the tax savings that you did right now versus having to wait all the way until 2027 actually realize that tax savings.
Yeah, and just to be clear there, Annie, it's a great question. If you don't host the two stays this year, you will not you can still do bonus depreciation on that property. Would not be for the 2025 tax year. It would be for the year that you put it in service, so it would be in 2026. So you can still get the bonus depreciation tax savings. It was just you delay it by a year
Yeah.
if you don't host two guests this year.
Yeah.
So great points. Lots of awesome questions here. Esmina Oro asked where to look for turnkey properties. Well, Rabbu is the answer for that. We do have a lot of turnkey properties on our site. We have a lot of properties on Rabbu that you can't find elsewhere. If you click on the top right, you'll see a section called feature properties. All those feature properties are properties that are turnkey, are existing short-term rentals that are ready to go and that you probably can't find on the MLS anywhere else. And Tyler's team or any of our other agents can still help you acquire those. So it's just Rabbu has become a marketplace for properties, honestly, before they hit the MLS a lot of time. So I'm seeing a lot of questions about LLCs. I don't know the answer to this, so hopefully you do, Tyler. But if you have an LLC or a partnership, can you still take advantage of this?
Yeah, you definitely can. When it gets into partnerships, it becomes a little bit more convoluted, and I don't want to answer there just because I'm not 100% sure. So that's something I would talk to one of our CPA partners about. But if you solely own the LLC, no issues there. You can definitely take the bonus depreciation. And Ika, you said real estate professional might be 750 hours a year. It might be. I want to preface all of this with like, I don't know everything. I only know what I know, and I'd be more than happy for you to prove me wrong so that everybody knows the right answer.
Yeah, or you can connect them to the right resources. Again, it's a relatively new tax code still. There's a lot of moving pieces. It's always smart to talk to a CPA or a tax accountant around it. Again, Tyler or myself are happy to make those intros if you need them. Let's see here. I saw some other questions. Jay asked, so if you say you have eight properties, so this question just moved on me. Say you have eight properties, do you have to get 100%, sorry, 100 hours per property, or can that be combined in any way?
That's a good question for a CPA.
Yeah, fair enough. Um, we don't know everything. Let's see. I saw another question here. Janet, you mentioned friends and family stays. How would we document that to qualify?
Maybe some photos. Maybe I would do anything and everything you can think of. Receipts, power
Receipts,
usage,
yeah, yeah.
utility usage.
Send them an invoice.
Have
Get a
them
check for the payment.
have them take selfies at your place, right? So if you ever do get audited, the IRS can see, okay, they were there on this date. The photo hasn't been altered, stuff like that.
Yeah. Kate asked, if you buy a current turnkey, short-term rental, how do you get to 100 hours? Um, it's obviously a little bit tougher, but you can get there. I mean, you still have to go to the property and get it ready. It's a property is turnkey in the sense that, guests are ready for it, but you probably want to go in there and make some minor changes just to spruce it up, maybe change some of the furnishings around, get better linens. You do have to spend time at the property. And then again, as Tyler mentioned, spending time on getting the property set up online, getting connected to appropriate software, interviewing the cleaners, the maintenance team members, everything you kind of need to operate, it all counts into it, and can get you there, as long as you have true effort shown, that you're heading that direction. Anything you'd add to that, Tyler, that I may have missed?
No, I think that's good.
All right, and then can combined W-2 income count, or does it count so let's say you file jointly with your partner. Um,
Yeah.
does that count, or is it for an individual
Yes.
basis? It's a partner
Hmm.
as an entity, right? If you file jointly, then that's how it works, right? There was a question about, I think it was Kristen earlier. Yeah, it was Kristen. She said she found a turnkey property, but it's a condo on leased land. Does that still work for cost segregation?
Good question. On lease, the lease land part is what I'm unsure of, but typically condos are actually really good for cost segregation because there's very little land value or the land value is split up quite a lot amongst all of the units. So we can talk about this a little bit because I think it is important, especially if you are an incredibly high W-2 income earner, you're looking at like how can I get the maximum tax benefit, right? How do I like make the biggest impact with my time and my money right now? The best way to do this is to find and invest in areas where the land value is very little compared to the structure value. So places where it's expensive to build, but the land is really cheap are really, really important. This is one of the things that keeps the Smokies going. It's incredibly expensive to build there. The structures are incredibly valuable, yet the land is incredibly cheap in the Smokies, in Gatlinburg, Pigeon Forge. And so you can only bonus depreciate the structure, everything inside it, all of the building. You cannot depreciate the land. So let's say that you buy oceanfront in Destin. It is highly likely that if you buy a $3 million oceanfront house in Destin, that $2.75 million of that is the land value, right? And so you can actually then only bonus depreciate. And these are kind of extreme numbers, right? Just to make my point here. And then you would only bonus depreciate the $250,000 structure. So it is important where you buy and how much that land is worth. So for instance, here in Asheville, North Carolina, land is worth very little, yet our housing prices continue to rise. And so typically our basis for the structure is about 95%. And so you buy $1 million house, you can bonus depreciate $950,000 of that typically. And then the land is worth about 50. So that's really, really matters. That's one thing that makes condos good is because typically the land is kind of split up amongst all of the units. And so it ends up being very, very little.
Yeah, exactly right. But I'm not sure, going to Kristen's question either, how it works on leased land.
Yes. Yeah.
I wouldn't think it matters just because the land value itself is not taken into account, but I'm not sure.
Yeah.
So good question. Unfortunately, Kristen, we don't have a perfect answer for that.
Yep. Shoot me an email.
I
We'll figure
Yeah,
it
shoot
out.
us an email. Exactly right. Interesting question from Glenn. He's probably feeling the time crunch a little bit. He says, since we have such a short time to take advantage of it this year, what are the advantages of waiting till next year at this point?
I don't see any advantages of waiting. What I would say is don't buy a property just to cost seg, right? I know for the last 50 minutes I've been saying like do this, do this, do this, do this, only if the property makes sense, right? You will never hear me tell somebody to buy a property just to get the tax benefits. There are, in fact, four pillars that you should be looking at when you're buying a short-term rental property. Okay, the first is cash flow. And so cash flow is very important. So if you're buying a property just to get the tax benefits, but it's not going to cash flow, you got to be very, very careful right now. Especially in these places where there's $1 million houses, the housing market is touch and go. It is a little bit up and down. You got to be a little bit careful getting into this craze in this heyday. I know it seems like everybody's looking at real estate right now. That's because of the time of year and tax benefits. That is going to slow down on January 1st. Really, it's going to slow down like December 1st, right? You're going to hear a lot of calm hit and people are going to be going crickets in the real estate market again. And so be really, really careful. The second pillar is tax benefits for buying a short-term rental. The third is appreciation, right? So you always want to look at what is the appreciation of a market, and you don't want to buy into a market that's not appreciating. That is the bank account, the piggy bank of your property. That's where you make sure you're not going to lose money. That's what makes it a safe investment. So really looking at buying in an appreciating market protects you. It mitigates all your risk. And then the fourth is debt pay down, which pretty much comes with any loan. So not something you have to super think about in one area or another, but definitely something to consider and run on a pro forma.
Yeah, I'm so glad you said that. Yeah, definitely don't just buy for the sake of saving some money on taxes here before the end of the year. Make sure that the property you're buying is actually something that guests want to stay in, and it's gonna meet your other financial goals, whether you're looking for cash flow and you have an appreciation play. Don't just buy something for that, and leverage Rabbu to help you find that property, because you definitely don't want to just buy something that's going to bleed money on a monthly basis just to save some taxes here this year. So very good point. I think the only big advantage that comes to mind for me is that if you don't have the capacity to pull it off by next year, you can actually take your time, find the right property, and then invest the proper amount to get it up to a luxury asset, so that you can then really kind of take advantage of the cash flow while also leveraging the time spent into retrofitting the property investments you make there on the upfit, because that can be depreciated as well down the line. But obviously, it would not help you till 2027. You wouldn't see that until 2027.
Yeah.
So
You're just not
just some of the things
accelerating
that,
things at that point. So, like, if
yeah.
you can find something this year, I think this is probably the best. Like, this is your last shot, certainly, but it's worth it. I mean, if you can find something great in some area of the US you maybe haven't thought of before. And here's what I'll say: stop looking for a lifestyle asset. Stop looking for somewhere that you want to go, blah, 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 blah. Here's what people always end up telling me when they look for that. They get this dream about owning a second home and well, we're going to go to Florida every year. We're going to do it. Your family gets tired of going to the same place every year. And what ends up happening is I get a call in 2 years and I'm like, well, how many times did you go to your lifestyle asset that you needed to buy for $1 million? Well, we went once and then we went to Alaska and then we went to Hawaii and then we went to Portugal and we went to Italy last year and we went on a cruise. And yeah, so we didn't end up going as much as we thought we did. It happens every single time. Stop buying a place to go there. Honestly, you should be buying a place that's going to rent out for far more than you would actually rent it for yourself. And then you can take that money and you can go anywhere in the world and rent the place you want to go. And maybe potentially that's in the same area that your house is in. But the goal here is to actually rent your house for more money than the amount of money that you rent something for in that area. So for me, I
Yeah.
never ever stay at my short-term rentals. I charge way too much. I would never pay the amount of money that other people pay for my short-term rentals.
Hey, that's great. And it's also interesting because the second you start thinking about staying there too, you're actually losing money. You're losing your return as well, right?
Yeah.
Because we see that a lot of times too. That was my initial thought too when I bought my first few STRs. I was like, oh, we'll just go there and stay on the lake, a few weekends. When you want to stay is when everybody else wants to stay too, which means
Yeah, it's
you're missing
Christmas
out
and
on
New
your
Year's and
right,
July
exactly.
4th on the lake, and you're like, man, I could make 10 grand, or I could just not go there.
Yeah, it becomes a actually becomes a really easy calculation when you start looking at it from that perspective. So also a really good point. So exactly right. Keep that in mind. This is an investment. It's not necessarily personal use. I think I saw a question about that somewhere. Yeah, Aaron asked, can you convert a second home to a STR for 6 months and get bonus depreciation?
And then
Eh,
convert it back? Good question. I'm not sure. I did see a question that I want to answer about kicking it over to a management company next year.
Oh yeah,
From
great one.
everything we've seen so far, because this is kind of a touchy subject, right? Like, why would they give you these tax benefits and then you can just kick it to it? You buy at the end of the year, put it in service, and you can immediately kick it to a management company after that. But so far, no one has ever gotten in any trouble for it. It's not well defined. There's not anything against it. That doesn't mean there's anything for it either. But from everyone I've spoken to, I still to this day have never heard of an instance where anybody got in any sort of trouble or recapture or anything like that because they kicked it to a management company on January 1st. So it is a tactic that somebody that wants to work with a property manager, they'll get in, get their material participation done, and then kick it over to a property manager on January 1st.
Yeah, exactly right. There's so many topics we can hit on property managers. My quick takeaway there is go local. That's your best bet
Yes.
if you want to be successful on the property management side. I know we're running short on time. I'm trying to make sure we get all the main questions answered
Yeah,
here.
and
Tyler, this was great.
I've got like an extra 15 minutes. So if anybody
Okay.
wants to keep going or stay on, I'm happy to do that as well. It looks like
Yeah,
I'm
same,
still like
same.
30 messages up in the questions right now. So
I know I'm trying to keep up with them. So guys, both Tyler and I are willing to stick around for another 15 minutes. So please keep sending them our way. I'm just going through here again, making sure.
I see a question from Colette about a self-directed IRA. No, definitely possible to use a self-directed IRA to get the funding, to fund the down payment and all the expenses.
Yeah. Question from Joshua just came in. They joined late. Is there a recording and available to listen to again? We'll share this again too. If you joined, we'll share this again with you with some of the pertinent kind of links that you need to get started. And probably some call to actions to get connected to some of our partners on the cost seg side and the tax side. So look for that in the next couple of days from either the Rabbu team or the Savvy team. We'll coordinate and get back to you guys. But I'm glad you guys are getting a lot of value out of here. So we'll make sure we make this publicly available to the team. Um, let's see.
And I just
Please
want to
keep
plug
sending.
real quick. I'm throwing this
Yeah,
in the
good.
chat right now. Like, if your goal is to buy a short-term rental this year, book a call with my team. They're free. They're available all week. It's called a market match call. And basically, what we do is we figure out what your needs are, your desires are, and then we help you try to identify some markets that you can look in. There's no hard sales pitch or anything like that. If it's helpful to you, then great. And if not, then no worries. But I always say, like, take advantage of as many resources as you can, especially when you're in a time crunch like this.
Yeah, exactly right. One of the first things I would do as well is I would talk to a couple of lenders, and I saw a few of our lender friends already in here. I saw Easy Street in here a little bit ago, and maybe a few others. Highly recommend talking to a lender sooner than later, as
You
well, just to
have to
kind of
have your
understand what.
pre-approval now. If you get,
Yeah,
yeah, if you don't have a pre-approval now, that's your first step for sure. And I put the Rabbu Airbnb loans link in there. It's such a great resource because Emir can connect you to like multiple lenders in a heartbeat or two. And
yeah,
so I think that's
and
so
there's
important.
Yeah, exactly right. You have to understand what your best loan options are. So I would definitely recommend talking to a lender. Think to a lender. I just posted our loans page as well. This doesn't do anything, doesn't check your credit or anything like that. It just asks you a handful of questions and then qualifies you and shows you the best lenders you can talk to. So feel free to leverage that as well today. Had a question from Simon come in or Robin come in. Robin Simon come in. Do you have any recommended apps for tracking software for the 100 hours of material participation? I usually just use Google Sheets, but I don't know. Do you do anything different, Tyler?
There is something out there that's specific for this. I think it's called Reps Log. Let me just see. Yep, reps-log.com, reps log. I'll put this link in there too. I have no affiliation with this company. I've never used them. I'm already a real estate professional, so I don't have to track these hours. So I just put the link in there. Track your time, secure your status is what they say. You can log your material participation hours, and it says get started for free. So I don't know if there's like any upsells or anything like that on the app, but it looks like it's actually an app you can download on your iPhone and Google Play as well.
Yeah. And Dasha, thank you for mentioning Clockify, looks like as well. Awesome. I'm not familiar with them. I'm a real estate professional myself, so I just use Google Sheets. I just do it just because it's easy for me. But yeah, it looks like this looks like a great resource as well. So thank you for sharing that, Tyler. Guys, keep trialing out. We'll stick around for another 10 minutes if there's questions for us. So please keep sending them our way.
Yeah,
Let me
there's a couple
see. That was
questions actually in the Q&A slot, not just in the chat. So
go for it.
Irene asked, she's under contract for a short-term rental in upstate New York. Do you know any designers that you can recommend? Irene, if you're going to get launched this year, you cannot use a designer anymore. Even if they promise you that they're going to be ready, I wouldn't put my hundreds of thousands of dollars in tax savings in anybody else's hand at this point. Make sure whatever lender you're using is incredibly confident that you're going to close on the timeline that they give you. Ask them how many loans are you doing for people that are trying to do cost segregation studies? You should immediately get an answer like, "Oh my God, I'm so busy. This is my craziest time of year, but I get it done. This is what I'm made for." If you don't get an incredibly confident answer like that, find a different lender because they are not going to get it done in time with the delays that are going to happen because of Thanksgiving being in the middle here. Steve Jones asked about two or three partners taking advantage of the cost seg. From what I understand, yes, you can split the cost seg benefits into different partners. What you do is you do a tax return for the LLC, and then you do a K1 to each partner, which would then have kind of the split up depreciation on it. And Steve also asked, do all partners of an LLC need to 1031 into the same replacement property? That is a very good question that I am not sure how to answer. I don't know if partners can buy separate replacement properties. You have any idea, Amir? You do a lot more partnerships than I do.
Yeah, I honestly I'm not sure either. I would defer there. I don't want to speak out of turn, so sorry, Steve. Yeah, ping either Tyler or myself. We'll get you connected to the right resources to answer that question. And as I mentioned earlier, we should probably host another one with maybe one of our partners, Tyler, just to kind of go deeper on some of these questions because it looks like there's a lot of great stuff
And
here
can
that we
I
should just help clarify.
Can I ask here? There's still 85, 84 of you left here. I know we've gone over a couple minutes here. Was this helpful? Can you guys throw it in the chat if this was helpful? If you're still here, please let us know if this was helpful to you guys. And then if as long as we get a good enough response, we're happy to do another one.
Yeah,
Maybe Thursday, maybe maybe tomorrow if we can round up people. I know I am doing a webinar on Wednesday with a cost segregation company, with a tax company. Potentially, Amir, maybe we can just merge that. Maybe
yeah,
we could do that together again. I pulled that
absolutely.
together on our own today, but we could just put that all together in one.
Yeah, we should because I think there's a lot of interest in just things that you and I shouldn't speak more on than we have just because it's not what we do.
Okay, so
We help you
you
find
guys that are
properties.
still here, the 80 of you, thank you for staying this long. We're going to have a cost segregation professional and a CPA available for you guys to ask questions to directly. And that'll be, sorry, Amir, we did this before we landed on the time, but we've already put up some marketing on it. So we're doing that a little bit later in the day just to make sure that we can get our West Coast friends. So we're doing that 7:30 p.m. on Wednesday Eastern time, so we can try to get some of our West Coast friends on there as well. Because this is important, and we really believe in this. I use this as a mechanism for wealth building, just like I've always used real estate as a mechanism for wealth building. This is that next level. This is where people buy yachts and planes and write off the entire thing and become billionaires.
Yeah, absolutely. And Scott, who is part of the Savvy team, just shared a link to the for the webinar in the chat. So encourage you guys to click on that. And I'm sure on that one we'll be able to go even deeper on some of the details and maybe even walk through some more specific examples because those guys will be
Yeah,
much more qualified to speak on some of those details. So highly encourage everyone to join that as well
for sure.
if you
Meg, I
can.
think Amir went through some of the best ways. I think some of the best ways to get that 100 hours is online participation, setting up hospitable hosts for your direct messaging, setting up price labs for your pricing, and the research and time that goes into that, right? You're going to need to sit on YouTube and research how to set up your price labs and do Google searches on how to set up your hospitable. You're going to have to upload your photos and edit your photos, right? Take time, spend time in Canva editing your photos. So I would say that most of that's going to be online, and then go to the property, fly out to the property for a couple of days. You'd be surprised how many hours you can rack up by actually being inside your property, changing light bulbs, right? Dusting off the cobwebs, mowing the grass. Get out there and put in a little bit of elbow grease into that property after you close, and you'd be surprised how quickly you can eat up those hours. And I think that's
Yeah,
basically the advice that most of the CPAs give.
absolutely right. I mean, even just like changing prices on a regular basis and communicating with the guests, all that stuff adds up quickly. And nobody ever is, I mean, um, if you can be directionally correct in your time spent, you should be fine. Nobody's ever gonna go, lock you down to the second on it. So, um, this has been great, Christine. Looks like you joined a little bit late. Yes, we will share a webinar, a recording of this webinar afterwards. So no worries, Christine. I apologize, Christine. Christina, we'll share that in the next few days. Thank you for joining us late. Awesome. Well, I think we got everything covered, most of the questions covered. If not, you'll probably get more detailed answers on the webinar on Wednesday. And it looks like there's one more from Sarah, registering an STR with the city, notifying neighbors via letter. Yeah, all those things. Exactly right. Yeah, I think Sarah was just giving us a few more examples. All those things take time. I think you'd be surprised how quickly you would get to that point. So,
Yeah. Yep.
it's,
An hour on the
especially
phone
when
with
you're getting it up and running.
utilities. Yeah, yeah. I mean,
Yeah,
it definitely adds up quickly. So just
yeah,
imagine, I mean,
especially.
how many hours do you have in a week, right?
Yeah.
Hundreds. So yeah.
Yeah, what is it? 7 times 24 is what? Yeah, well, yeah, you're right. It's like 172. So yes, you can make it happen.
Yeah.
There's time to be made. So awesome. Well, Tyler, thank you for joining. It looks like this is a big success. People loved hearing about this topic. I encourage everyone to proceed down this route. I mean, if you can find the right property, Rabbu can help you do that. Savvy can help you do that. We highly recommend going this route. And we're here. Both my team and Tyler's team are here to help you guys along the way. As you just see, Tyler just shared his personal email with everyone here. If you have any questions, feel free to ping him, and we're happy to be your support system in this journey. We've both Tyler and I have been there, and we're just kind of sharing the knowledge on to everybody else. So thank you guys for joining. Really appreciate having you here, and yeah, look for more updates from Tyler and myself in the coming weeks. And best of
Thanks,
luck.
Amir. Good to see you
Thank you,
guys.
guys.
Thank you so much.